Good morning and welcome to Netwealth's latest webinar on intergenerational wealth. My name is Tom Kimchi. I'm the head of advice here at Netwealth, and I'm joined today by a close colleague of mine, Lily Ball, who works with me in the advice team. And today we're going to be talking about wealth, inheritance tax, estate planning, and some of the changes, of course, announced recently last year in the budget. So we're going to cover today the things you can see on your screen. So changes to inheritance tax and what that means for passing on wealth to the next generation. We're going to look at how you might want to consider revising your plans to protect your assets. We're going to look at your options in the current situation, and then of course financial planning and how advice might be able to help. It might be able to optimize your plans and make the best of this new situation we find ourselves in. Many of you have sent in questions ahead of the webinar, so thank you very much for that. And we'll try and answer as many of those as we can during the course of the webinar. If you have any more, feel free to send those in using the functionality on the application. And of course, if you have any more personal questions or anything more detailed, feel free to send those in to advice@netwealth.com. You can see that on your screen. And finally, relating to feedback and questions, you have all been invited to a one-to-one follow-up session. So you might have seen that when you registered for this webinar. If not, we'll send a link at the end, so you can certainly book in a complimentary session to discuss any questions, considerations, or talk about the possibilities of advice at Netwealth with us. And finally, a little bit of housekeeping. If there are any issues, it tends to work well if you refresh your screen, if you stop being able to hear us or anything like that. So I'm going to kick us off today by talking about some of the recent changes, first of all. So what happened at the recent budget late last year? So inheritance tax was one of the big focuses, of course. Some things haven't changed. I'm sure most of you will be aware the big change was point 5 here, which I'll come to shortly, pensions falling into the scope of inheritance tax from April 2027. But the nil rate band hasn't changed. So the nil rate band is how much you can pass on to your beneficiaries. Often that'll be children. So if I do mention beneficiaries, for a lot of people that will just be their children, but it doesn't have to be. It can be another family member, a friend, or a charity. So nil rate bands are frozen at £325,000. The residence nil rate band is frozen at £175,000. So if you're passing on, say, your primary residence to a direct descendant with that particular point 2, then between a couple, you can pass on £1 million in total. So that's £325,000 at £175,000. With two people, that makes it £1 million. So that's still the same until 2030. Agricultural, business property, and AIM relief is reduced to 50%. So that's negative for people that were aiming to pass on assets using those reliefs. Potentially exempt transfers, sometimes known as the 7-year rule, just simple gifts made to children, beneficiaries, whoever it may be, that's unchanged. And we'll talk about that quite a lot during the rest of this webinar, some of the advantages to using that more than you might have otherwise done. And that's because of point 5 here that I've touched on already. Pensions are now within the scope of inheritance tax, or they will be from 2027 at least, so not too far away. It will come around quite quick, I'm sure. And we'll have an example of what exactly that means. But of course, that is quite a big change with lots of people in the UK, particularly those that are retired, of course, having a lot of their wealth tied up in pensions, and defined contribution pensions in particular. So looking at pensions in a little bit more detail, I've touched upon the estate planning side of things and that negative change for most people. But there was lots of speculation, I'm sure some of you remember, before the budget. So I'm just going to quickly talk about some of the things that weren't actually changed. So the lifetime allowance, the LTA, the top bullet point on the left-hand side here, that was not reinstated. So when the Conservative government abolished the LTA, removed the LTA, which was the cap on how large your pension could grow before you paid a punitive tax charge. When the Conservatives announced that, the Labour government in waiting at the time, they said if we get in, which was looking quite likely at the time, we would reinstate that lifetime allowance. We would re-establish that tax charge. So that didn't happen. And actually, before they got elected, they sort of let on that that wasn't likely. Of course, though, it could come back in the future. It's not as if they've said that they will never, ever think about re-establishing it or something similar. But certainly for the time being, clients won't have to worry about that. The 25% tax-free entitlement remains. It is still related to what was the old lifetime allowance, not directly, but the figure now for how much tax-free cash you can take is capped at what it would have been under the old lifetime allowance. So it's just over £268,000. But nonetheless, if your pension's less than £1 million, you can effectively take 25% tax-free, which is unchanged. So lots of clients worried about that being taken away, and should they take their tax-free cash ahead of the budget? Well, some people did that anyway, but there wasn't particularly a need to, although of course, many people had reasons to take the money for other reasons. And then income tax relief on contributions hasn't changed. There was talk of that potentially being reduced, particularly for high rate taxpayers. Currently, if you pay 40 or 45% tax, you can get that as tax relief if you make a pension contribution. That still applies. The annual allowance still applies where it was previously at £60,000 per annum. And the bottom point there is investments within a pension still grow tax-free. So no capital gains tax, no income tax on dividends or interest. So overall, there's still a great savings vehicle. It's still very sensible to top up your pension. For most people, it's just that the estate planning side of things has drastically changed for the negative, because now there is 40% inheritance tax on what remains in the pension, essentially, after your nil rate band's taken into account. So let's look at a case study, a simple example here to just show the difference, what it could mean. So here we have Amir, who is 80 when he passes away. So he's past the age of 75, which means that his beneficiaries will actually pay income tax on the pension. And we did have a person that asked a question about the double taxation there, and there is an element of double taxation, as there often is in our tax system. So if you pass away over the age of 75, you pay inheritance tax on the pension, but then your beneficiaries, whoever inherit the pension, they also pay income tax on income withdrawals. But with Amir here, his pension is valued at £400,000. The remainder of his estate is £1 million, so 1.4 million in total. Amir has an expression of wish in place, which nominates his grandchildren as the chosen beneficiaries. They can take the pension either as income or a one-off payment, which ultimately is the same in terms of taxation, but it's just a choice of whether it stays in the pension or whether it's paid out to them when the estate's settled. So before 2027, where we are today, Amir's estate is £1 million. The nil rate band is £325,000. The taxable estate, therefore, is £675,000, and the IHT on that is £270,000. So essentially, the pension's just not included there. From the 6th of April 2027, the change, of course, is that £400,000 in the pension is now part of the estate, ultimately. So you still have the nil rate band, but it means a taxable inheritance taxable estate is now £1,075,000, and it means there's IHT tax of £430,000. So quite a lot more than it was previously. And the way that is worked out is, as you can see from the calculation at the bottom on the right hand side here, is the inheritance tax is split proportionally between your pension and your non-pension assets. So effectively the pension would lose £122,000 or a little bit more, and the non-pension assets would lose £307,000. So as I touched on earlier, the pension wrapper can still be retained, so you don't need to liquidate the pension, so to speak. It's just that tax will have to be paid before somebody can inherit it. So what might you want to do to revise your plans to protect your assets? Again, touched upon it very briefly, but gifting, using that 7-year rule, could be one of the key things to look at here if you weren't looking at it already. And if you were, you might want to look at making larger gifts. So taking the 25% tax-free lump sum makes sense, especially if you were to consider gifting it, as in, it's not necessarily a great idea to take it and have it to just sit in your estate doing nothing, because then you still pay 40% inheritance tax on it. But if you take it and you gift it, then it goes to your beneficiaries, of course, and if you survive 7 years, then you have avoided tax on that. So it does mean giving up control. It does mean a loss of flexibility from your point of view, but it does essentially achieve the same end result of avoiding inheritance tax on that sum. Another thing you can look at is spending from your pension. If previously that would have been untouched, then you would now pay 40% inheritance tax on that. But now, certainly, potentially, well, not certainly, but you should certainly consider a blended drawdown strategy. For lots of clients, it's good to use up their basic rate income tax band. So taking enough income so that they have about £50,000 of taxable income. So they only pay basic rate tax on that. So that often involves pension withdrawals and then drawing other income from maybe general accounts or ISAs. Another thing to consider, of course, is just spending more. Now, we wouldn't generally advise just spending for the sake of it, but if you had reason to do so, then that is, of course, going to lower your taxable estate. And then we go into a little bit more detail here on the gifting side of things. So, of course, this hasn't changed, but you can give £3,000 a year to anybody without tax consequences. For larger gifts, you need to survive 7 years. But again, the great advantage there is it's outside of your estate. Gifts to spouses, civil partners, or charities, there isn't a limit on that. So if that was your intention or that's your plan, then that's also sensible to consider. And the final one on this list here that's often not that well known are gifts out of excess income. So this is a rule that's in place already, but it might be something that we see people do more often. And this is if you have an income source, it could be rental income, it could be a defined benefit pension or final salary pension, it could just be taxable income coming out of your pension. But if you have records that can demonstrate that this is excess income, you don't actually need it for your own standard of living, you can make gifts using that income, and that's immediately outside of your estate. So you don't need to survive 7 years. You do, though, need to be able to demonstrate that it is out of excess income and it is regular, and it's not giving away capital effectively. So for people that don't necessarily want to make large gifts immediately, but they do want to lower their taxable estate, they might want to consider using this rule to lower their taxable estate over time. So lots to consider there, and we'll talk about some more examples later on. I'm now going to pass over to Lily, who's going to talk about how you might want to think about how much you can afford to gift, if that is your intention.
Thanks, Tom. So pensions are still an effective retirement planning tool with the tax relief, as Tom mentioned, but are now a less effective tool for passing on wealth as perhaps they once were. So then gifting really comes to the fore, and I'm going to run through now the importance of gifting, how this can be used in your new intergenerational wealth plans, but firstly, how much can you afford to gift? When we're looking to answer this question, we have to focus on how much we need ourselves before we can start giving away our assets. So how much do you need for your own retirement? And for the best outcomes here, we come back to something at Netwealth that we call controlling the controllables. So if we look at the left-hand side here, you can see the things that are out of our control when investing for our retirement. And those are market performance. So instead, focus on the long-term average return, inflation eroding the real value of your capital, and then finally, how long we live for. So needing our retirement pot to last longer than we may think. These are out of our control, but they're definitely things that we can model for, and I'll show you later in the session today how Netwealth's proprietary tools factor in the uncontrollables listed here, like inflation. But those are the factors out of our control. So instead, let's focus on the right-hand side here for the best outcomes to our retirement plans in what we can control. So spending time in the market rather than just jumping in and out during periods of market volatility leads to better outcomes. Having a well-diversified multi-asset portfolio for your retirement funds, utilising tax wrappers and allowances, so pensions and ISAs, and finally, minimising fees. Now, some of you may already be aware that that's a key focus at Netwealth. Whatever stage of investing that you're at, if you're at the start of saving for retirement, higher fees are going to eat away at your take-home returns, and that can really compound drastically over time. But similarly, if you're in the retirement drawdown phase of investing, minimizing fees is important to give your pot the best chance of lasting for the required number of years and ensuring you can draw the highest possible level of income from that pot, resulting in both the maximum amount for yourself for retirement, but also the maximum amount that you could then look at gifting to your beneficiaries. So focus on controlling the controllables, give your retirement pot the best chance first of meeting your own goals, and then that will maximize the potential wealth available to pass on through gifting. So this slide hopefully highlighting a good general rule of thumb to improve investment outcomes and have more to pass on in the first place. Now, one of the uncontrollables I just mentioned on the previous slide is longevity risk. None of us know how long we're going to live for, and so your retirement pot might need to last longer than you think. We're all living longer, which is obviously great, but for your financial planning, the risk comes in needing more funds to pay for these extra years of life, and perhaps also things like increased healthcare costs. So we have to ensure our retirement pot is equipped to last longer than we may expect before we consider how to pass on our wealth. At Netwealth, we address this longevity risk by always modelling to age 95 for prudence. And again, I'll touch on that later when I give the demo of the tools we use for our wealth planning. So after you've analysed and modelled for how much you can gift, the next step to then really think about is when to make that gift. Typically, when thinking about intergenerational wealth and passing this on, it's associated with the passing of a loved one at the latest possible point in our lives and receiving funds through probate in the will. But when looking to pass on wealth tax efficiently with gifting and the 7-year rule, these plans and the passing of wealth and the timing around that are actually best made before that point to fully fall outside of the scope of inheritance tax. So if we look at the graph on this page, we can see what we all know already, that wealth increases with age, with 55 to 64-year-olds accumulating the most wealth, having worked for a long time to build up their assets, having potentially paid off a mortgage, etc. It then starts to decrease when you stop work and start drawing on those assets to provide your income through retirement. But if we look at this chart instead, focusing on which age group the gift might be the most impactful, we can see that whilst we may be further along to the right-hand side when thinking of gifting ourselves, the people who benefit most or who would benefit most from a gift are in the first 2 or 3 categories, whether this is a child or a grandchild in the accumulation stage of their life. So thinking about gifting from this perspective of when will it have the most impact for who I'm looking to pass my wealth on to is important. And when we pass naturally, it's likely that our children may be further along to the right-hand side of this chart as well as our life expectancy increases, where they may be more middle-aged and have already accumulated a fair bit of wealth themselves. Therefore, gifting sooner may actually be more beneficial for your beneficiaries when they're younger and on the left-hand side of this graph, where the cash flow might be a bit more stretched. Whether this is things like helping a grandchild with a deposit for a house or helping your own child pay off their mortgage earlier, helping them with education costs and so on. So whilst we may not like to part with the cash sooner due to the control we then lose, once we've modelled for how much we can gift after, as I said, accounting for our own needs and decided to gift to pass on that wealth, looking at when the gift may have the most impact for your beneficiaries is important. And typically this is younger rather than older when they're in the earlier stages of accumulating their own wealth. Now, whilst on the topic of making gifts, we did have a question in beforehand asking what records should be kept for gifting, how far back should these go? So the person who deals with your estate after you pass needs to work out what gifts were given in the 7 years before your death. So keeping clear records of what you gave, who you gave it to, the value of the gift and when you gave it is important. And there are further records and evidence that needs to be satisfied, as Tom mentioned, if the gifts were made regularly and out of surplus income, as those immediately fall out of the scope for inheritance tax, but certain conditions do need to be satisfied for it to be considered a regular gift out of excess income and not a regular gift that is a potentially exempt transfer and starts the 7-year clock. For sort of more detail on that, it's worth checking the HMRC website for whether the gift you're looking to make is that potentially exempt transfer or whether it's a regular gift out of excess income and so immediately out of your estate, and what documentation you might need to evidence this. Another question that we had in beforehand was asking whether a grandparent can pay for their grandchild's university fees and maintenance costs and whether that's exempt from inheritance tax. So this could be a good example of what's a gift and a potentially exempt transfer and what's a gift out of regular income. So if you're making regular payments to your grandchild, for example, helping with their monthly rent and covering their monthly living costs, there's no limit to how much can be tax-free immediately, as long as it's classified as that normal expenditure that's then going to come out of your regular income. So it can be classified in this way if you can afford the monthly rental payments, for example, after meeting your own living costs, and the payments are made regularly from your own monthly income. University fees might be seen differently. They might be considered gifts, even if they're paid directly to the school. But potentially, if you're paying termly, it might be different. And again, if you can evidence that it's coming out of that excess income, but that might be slightly harder due to the sort of larger amount. So yeah, you can of course pay the university fees from your savings and investments. It'll just be considered a potentially exempt transfer, considered a gift, start the 7-year clock on the amount given. It will be less the £3,000 gifting allowance if that's not been used for the year. But yeah, those are some things to consider. So as I mentioned, Control can be a big thing with gifting and how the money is spent and on what, as once it's gifted. Although you can be clear and have conversations on how it's to be spent, ultimately you don't have control. So that brings us to the control conundrum and how to consider your options for passing on wealth in light of this. So on this slide here, you can see the left-hand side of the scale, we have tax efficiency, and on the right, we have control. When deciding which option works best for you, there's typically a trade-off between these two. So keeping control of your money, what it's spent on and how it's spent, versus the tax efficiency of that option. So the more control you wish to retain, the less tax efficient options there are, as shown by the right-hand side. So trusts and companies with complex structures, they give you more control on how that money is spent when it's received by your beneficiaries, but it does come with ongoing administration, cost, and often increasing tax rates. In the middle, you can see pensions, which prior to the budget last year were a good middle ground. However, that's now blurred out as they are inside of your estate. So moving to the left-hand side, we can see that a simple gift to an adult child, for example, is very tax efficient. Whether this is gifts out of excess income, as I mentioned earlier, using that £3,000 gifting allowance each year, or doing a larger gift, considered that potentially exempt transfer, and starting the 7-year clock. However, once this gift is given, you have no legal right to that money or control over how it's used. So gifting is less complex, less administration, and can complement your long-term intergenerational wealth planning if you're comfortable relinquishing the control element. But it may be that a blend of the above, depending on your circumstances, works best. Typically, a good starting point can be smaller, more frequent gifts to see how the beneficiary behaves and begin an education process with regards to investing and finance and opening the door to those conversations that nobody likes to have about money. But that these conversations can actually be really constructive and helpful in explaining the desired purpose for the gift. And it's something we regularly help our clients with on the education side and, of course, on the financial planning side as well. So at Netwealth, when you invest with us, included in the investment management fee that you pay is access to the advisory team that Tom and I sit on to sound check your financial plans. So if you don't require the formal financial planning that we do also offer and that Tom will touch on in a bit more detail later, we can aid in these conversations, hopefully, hosting meetings or phone calls to highlight the importance of investing to the younger generation, and also talk you through the rules associated with gifting and be a sounding board for your intergenerational wealth plans. A good starting point for this, if you've not booked in already, is that complimentary one-to-one with the advisory team offered in conjunction with the session today. If you haven't booked in already, a link will be sent around afterwards, and these sessions can be really useful guidance on what intergenerational wealth strategy may work best for you in your specific circumstances. So further to conversations and access to advisors, we also have something called the Netwealth Network, which is a useful tool for intergenerational wealth planning and implementation. So the Netwealth Network means that the lead investor, so typically the person with the most wealth who may be then looking to pass this on, who's reached the £50,000 account opening minimums, can then invite up to 9 friends or family members to join their network. Importantly, the network members benefit from a lower fee depending on the fee band of the network they're joining, but also the account opening minimums drop from £50,000 to £5,000 for the network members. And this is important for intergenerational wealth planning with this reduced minimum, as grandparents or parents can look at making an initial gift, let's say £5,000, into an adult ISA for a child or a grandchild, and the beneficiaries benefit from access to a discretionary wealth management service that typically may have high barriers to entry through those higher investment account minimums that younger people might not normally be able to meet. They can then have their own conversations with the Netwealth advisors on the importance of investing, how to best use the funds that they've been gifted to meet their financial goals. So whether that's building up for a house deposit or a longer term savings goal. The accounts remain private and confidential, but as a client of Netwealth, you can easily transfer the funds from your account to a network member as a gift to begin that 7-year process. and also start the important conversation around gifting with your family members with access to the Netwealth advisors to assist. So being a client of Netwealth, utilising our network, our advisors and our tools can help with your intergenerational wealth planning and also the execution of those plans with the next generation as your network members. We also offer the following account types in addition to regular general investment accounts, adult ISAs and pensions to help with investing for the next generation. So firstly, they're JISAs or junior ISAs. These can be set up by a parent of the child and can be funded by a grandparent with the £9,000 per annum allowance. Like an adult ISA, the growth is tax-free within the wrapper, and when withdrawn, the proceeds are also paid tax-free. So JISAs legally turn into adult ISAs in the child's own name at age 18, so they then have full access to the funds. But as mentioned before, starting that discussion in advance of what the intended purpose of these funds is for, university education, first property purchase deposit, etc., as well as using the tools at Netwealth to show the power of investing and compounding and being able to talk that through with an advisor, and looking at the amount put in, how much growth there's been, can be really useful. Now, JISAs are limited in the amount that can be put in a year to benefit from that tax-free growth. But if you are after a more flexible structure, then bear trusts or JGIAs, junior general investment accounts, can be set up by anyone, and any number can be opened on behalf of a child, unlike the single JISA per child set up only by a parent. Bear trusts are more flexible than JISAs in that there's no limit on contributions, and the funds can be accessed at any point, but for the benefit of the child, so to pay school fees, for example. But with this increased flexibility comes drawbacks against the JISA in that the returns are taxable. But in some situations, the Bear Trust may be able to make use of the child's annual tax allowances for income and capital gains if the settler of the trust is a grandparent. So there is some nuance, and the details of these different account types and what might work best for you can, of course, be discussed with an advisor at Netwealth. So book in those one-to-ones if you haven't already, and we can cover this off in a bit more detail. Netwealth also offer trust and corporate accounts, but the legal structure must already be in place where we can then be appointed the investment manager of the trust or corporate assets and manage the wealth in this way. So now I'm going to pass back over to Tom, who's going to talk a little bit more about how Netwealth can help with the formal financial planning and advice.
Excellent. Thank you very much, Lily. And before I do, I'm just going to take a few of the questions that have come in as we've spoken, certainly the ones that I can answer quite quickly here. So one question was on pension funds. Can they be transferred from a parent to child tax-free? So the simple answer there is no. Certainly not tax-free. From 2027, there'll be inheritance tax on the inheritance of the pension, 40% there, on the excess beyond the nil rate band. And if you are over the age of 75 when you pass away, not only do you pay the inheritance tax, but your child would also pay income tax on income they take from the pension. So certainly not tax-free. And also it's not tax-free even before 2027 from the age of 75. And so a follow-up question there as well, can they move pension to pension? Yes and no. So a child can inherit a pension, but they pay tax on it in the same way. So if a client, for example, and we've seen this before at Netwealth, they might have their own Netwealth pension, a younger person, and if their parent was to pass away, they can inherit that, pay some tax, but then they have two pensions. They can't be merged together, but they can sit right next to each other and be considered in a very similar way. A question on regular payments out of excess income. Can they go to a discretionary trust? Yes, they can. That is a gift in the same way an outright gift would be made to a discretionary trust. Although it's not that beneficial to do that, only because you can already make gifts to a discretionary trust up to the nil rate band, £325,000, and not pay any immediate tax. So you can do that. It's just not going to make that much difference compared to what you would do otherwise. And then somebody else has asked, do payments of tax-free cash from your pension count as income for the gifts out of regular income? And not usually for that, because it's not regular. It's just a one-off payment. as opposed to taxable income, which is supposed to be sort of an alternative to an annuity, which was what you were obliged to buy not that long ago. So yeah, it does normally need to be excess income that's taxable and sort of an alternative to an annuity, almost conceptually at least. So now I'm going to share my screen and talk about our approach to financial planning and advice. So let me share this for you, and then I'll begin. And again, feel free to send in more questions if they come up, or otherwise wait for your one-to-one follow-up, of course. So we offer financial advice at Netwealth, and it really aims to boost the effectiveness of your long-term planning. So we look at your circumstances, your objectives, of course, and we provide personal recommendations. That's really what makes it financial advice or financial planning advice. And it's designed, of course, to meet your needs and help you achieve your objectives in the most efficient way. In the context of passing on wealth, financial advice does tend to be required here to give detailed answers. Of course, we give guidance. We do webinars like this so that people have an idea of what's happening, but often to really make informed decisions and make sure you have enough to meet your own needs and to make sure you're drawing income in the most efficient way, advice is often really, really helpful. So we sit with clients often to help them set their goals, to think clearly about what is it they want to achieve, what is their priority. Are they very keen on retaining an element of control of their assets, or are they most concerned with just minimizing tax? We nearly always look at cash flow modeling, both to help inform the recommendations themselves, but also to demonstrate to clients the benefits of making the recommended actions. And also so clients have a good idea of some of the range of outcomes. So you can see very briefly on the image in the middle of the screen here, and Lily's going to do an example later where you'll be able to see much more clearly. But of course, we don't know what's going to happen in the future. We don't know exactly what's going to happen with investment returns. We definitely don't know what's going to happen at future budgets in terms of legislation. So there will always be a range of outcomes. And we find it's really helpful for clients to see that so they can build in an element of caution and make sure that they're not relying on everything turning out perfectly. And having that cash flow model can help show you what the likely ranges of potential outcomes are. And then also asset allocation, of course, is very key to that. So the more risk you take with your asset allocation, so the more investment you have in equities or company shares, the more volatility there's likely to be, and that can widen the range of potential outcomes. But also more risk generally means greater returns. So again, when thinking about estate planning, thinking about how much you might pass on, it's also really important to think about how the sum's invested leading up to the gifts or afterwards as well. If you gift into a trust, say, how is that trust managed to maximise the potential that your beneficiaries receive in the end? So advice at Netwealth covers all of those areas. You can see some of the key points we touch on at the bottom here. So asset allocation I've talked about, income analysis, pension planning, whether that's transfers, whether that's making contributions, retirement planning is very related to that as well. Pension consolidation, so often clients have various pensions that they've accumulated over their career and they might want to look at the merits of consolidating them, putting them in one place so that they can have a coherent strategy moving forwards. Drawdown strategy is really important, particularly if you're just thinking about gifting assets and you want to make what remains in your estate last as long as possible, looking at using those basic rate tax plans I touched on right at the beginning, and then cash flow modeling that I've touched upon to help demonstrate what that all looks like once put together. And then also, of course, estate planning and investing for children, very topical to this webinar today. It's not just the gifts themselves or what you do to move assets out of your estate. It's also thinking about how children themselves invest, because it's also really useful to use your children's junior ISA allowances, for example, or sometimes even their own pension allowances. We quite often see situations where you have young adult children that are maybe earning a fairly modest wage. So even though they personally couldn't afford to use their pension allowance because of their cost of living, if their parents could make a gift to them, they could put quite a lot into their pension. So it's not estate planning per se, but it is still investing in a very beneficial way for your children. And it also, for some clients that don't quite want to give their young adult children lots of money, if they ask their child to pay into their pension, then it ties it up until the child's older. So it means that the child doesn't necessarily have a negative incentive to work hard themselves. So there are other benefits there as well. Netwealth's advice can be provided fairly uniquely on either on a one-off basis or on an ongoing basis. So the ongoing basis is probably one that a lot of you are familiar with. It's the traditional service. Now, we don't charge any one-off fees at all for that, so that's pretty unique still, but nonetheless, it's a percentage fee for the assets we manage. We usually have an initial piece of advice that looks at your circumstances and recommends the best course of action, factoring in things like estate planning, of course. And then we have 2 meetings a year usually to update our plan and take into account changes to client situations. Changes to legislation as well, of course. We also advise on a one-off basis for a fixed fee. So we discuss your circumstances. What are your objectives? It might be your objectives are to retire comfortably and pass on as much wealth as you can to your children. We provide a fee quote for that is fixed. We then generate our report, provide the advice, have a meeting with you to explain it and implement it if you'd like to proceed as advised. So two key bases there, and clients can also switch between the two. So it might be that a client takes the one-off piece of advice to begin with, likes what they've seen and wants to move to the ongoing advice basis. So in that case, we would waive the fee and move them to that service. It can be the other way around as well. Clients can start with an ongoing advice basis, decide after a couple of years that their plans are pretty static, they don't need that anymore, but maybe they'll take a one-off piece of advice in a few years' time if their circumstances change. So what do we offer specifically then? So we do offer advice, as I've touched on, but we don't make it compulsory again, which is pretty unique, I would say, in the industry. So our core service on the left-hand side here and on the table to the bottom, that shows you what's included there. So the core of the service is the professional investment management, managing portfolios on behalf of clients. Looking at a really simple case, it could be somebody that has a pension, say. Maybe they don't have ISAs, they don't have general accounts, they just want to maximize the return of their pension for a given level of risk. But they also want some of the other things you can see on the left-hand side of this table. So guidance provided by qualified advisors. So not formal recommendations, but still the ability to speak to us, ask questions, receive factual information. They might also want to use our wealth tracking and planning tools, which Lily's going to demonstrate and look at very shortly. They don't want regulated financial advice, that's not included. They don't get a bespoke financial plan, they don't get the semi-annual reviews, but they can still attend our events. So that's the core service. It's really having their investments managed in a professional way and access to advisors. But then the advice service, of course, goes a step beyond that. It provides those bespoke financial plans, and it's really for clients that have either more complicated affairs or really just want peace of mind that they're doing the right things and they don't necessarily have to attend the webinars themselves if they don't want to. They can wait for their meeting and feel assured that the proactive advice to keep them in the optimal place will be provided to them. And then you may be wondering, how much does that cost? So we have that here for the core service. As you might imagine, it is naturally cheaper. It's 0.35% less than the advice service. And you can see it depends on how much is invested, what the total fee is. So for the core service, investing £50,000, it's 0.75%. Advised, that goes up to 1.1%. For those investing more than £5 million, the fees drops down to 0.35% just for the investment management, or 0.7% for the fully advised service. And you can see at the bottom there, the underlying investments that we invest in on your behalf, that adds another 0.1 to 0.45%, depending on the risk level and whether you apply for our SRI approach or our core investment strategy, which is non-constrained. And finally, you can see on the left-hand side here what exactly that covers. It covers investment management, it covers custody, transaction charges, administration, and any applicable VAT. So what you see there is a true all-in cost. It's very straightforward. As I mentioned, no initial fees at all for the advice service. So if you wanted that, you would just pay the ongoing fee and no sort of one-off upfront costs. I'm now going to pass back to Lily, who's going to show my Netwealth and some of our financial planning tools.
Yeah, thanks, Tom. So I'm just going to share my screen now and show the My Netwealth financial planning tools. So these can be used by anyone who registers. You don't have to be a client, and these tools are good for creating a clearer picture on how much you yourself may need, but also how much you may then be able to pass on to future generations through gifting. So I'm logged into a demo account here, but if you just go to www.my.netwealth.com, you can have a look and register and sign up yourself. So firstly, to give you a quick tour of all the tools available on my Netwealth. This is the wealth tracker. So this is useful for seeing all of your investments in one place. You can add all of your positions with different providers. So Hargreaves Lansdowne, Interactive Investor here. And of course, if you have Netwealth accounts, they automatically pull through. So this is useful for transparency, being able to track everything in one place and to see both your asset class exposure overall here and how much of your assets are in which account type here. So with this demo account, you can see the majority of the funds are in the pension and so tax wrapped, and the assets overall are roughly about 70% in equities. So the asset class exposure can be useful because sometimes we might be invested, in positions called balanced fund, this or managed fund. And this tool does a detailed look through for you. So all you have to do is type in the fund, what it's called, and we will do the look through for you of exactly what assets are held in that. Is it equity? How much is fixed income into that balanced fund, and how that impacts your overall picture. So very good for transparency and exactly how you are invested. If we now go over to the wealth planning tools, you can see that the information inputted on the wealth tracker pulls through down here, and you can also add some inputs yourself here. So we can see that for this demo account for Robert, he's 51, he intends to retire at 57. His current salary, monthly target income once he stops work, and any one-off withdrawals that he's looking to make. So as I mentioned, this tool's useful for your retirement plans, first and foremost, so seeing how much your assets will grow and whether the desired level of retirement income, so £5,000 in this case, is sustainable. But it can also be useful for gifting because you can enter a gift in here as a one-off withdrawal. So we can see if we scroll along, we're currently at age 51. We've got a one-off withdrawal here for his children of £500,000 in 2 years' time. So you can see the growth in the portfolio and then the drop-off when he makes that gift withdrawal, continued growth whilst he's working, able to keep saving and accumulating wealth. All the way along here, we have another one-off withdrawal of a mortgage repayment, and then we reach the retirement age here, where you can see it's then levelling out as he draws on the assets. But this is showing actually that £5,000 net monthly income does look attainable for Robert. So what we can do here then is go into the inputs, look at the impact of perhaps a higher monthly income. So let's say £6,000 in there instead of the £5,000. And then perhaps adding another goal of another gift later down the line. So let's add a new one-off withdrawal. We'll call it second gift. And we'll say £250,000. We want to make it in 2035. And you can choose the goal here of gift. Save that. And then go and rerun your projection. So we'll just wait for that to load. So now we can see the impact that that's had on his financial plan. And actually, with that slightly higher income and the additional gift, Robert's now unable to comfortably meet his own retirement needs until age 95, as he was before. So as I said, the tool models to age 95, and we can see here, if we hover there, that actually on average, the funds are going to be fully depleted by the time that he's 82. So let's go back into the refinement again and play around with the numbers. So if we change that back to £5,000 and then perhaps edit that second gift so that it's a slightly lesser amount. He's already done the larger one-off gift to help with education costs, property costs whilst they're a bit younger. This is mainly then this gift to just look at depleting the funds as much as possible and not leaving a large estate for inheritance tax purposes, whilst also leaving enough time for the 7-year rule. So if we rerun that projection and reduce the size of the second gift, you can see that it's looking a little bit healthier here. And if we follow along to the end of the chart, we can see that actually at age 94, in average market scenarios, there's still going to be around £1 million left in his assets there. So much less than was at the previous projection without that second £100,000 gift that we're looking to make when he's 61, and the funds are likely to last the right amount of time to provide for his own needs, and also reduce the size of his estate there. So yeah, these tools can be useful to play around with yourself, enter your own inputs, see what might be achievable, and then adjust the different inputs just to see the impact that then might have on your plan. But if you do want to discuss the plan in more detail, down here you can book in a call to speak to one of the advisory team, where hopefully we can help. So I definitely suggest registering to use the My Netwealth tools, because they can be used both for checking that you're going to meet your own retirement needs, but then also adding in some one-off withdrawals. You can do that for gifts, you can do that for healthcare costs. You can see in this demo account, we've also got it for a mortgage repayment, and seeing what you can afford to gift and use this to aid your planning. Using these tools, utilizing the Netwealth advisory team where applicable to help make those intergenerational wealth plans more effective and maximize their impact. I'm now going to pass back over to Tom to sum up the important points covered today, before we look at some of the questions that you guys have sent in during the session.
Great, thank you very much, Lily. So I'll briefly summarise and then we'll look at some of the questions. So we've had some that have come in as we've been speaking, and then there were some sent in before as well. So we'll try and cover as many as we can in the time remaining. But to summarise the content we've delivered so far, the rules around IHT and pensions have changed, of course. So it will be important as ever to update your plans one way or another. I guess you don't necessarily need to update the plan, but it's certainly good to check the plan and make sure it's still applicable. Because actually, if you do want to retain full control, then you might not necessarily want to make gifts. So that is worth bearing in mind, but it's certainly worth having a look and making sure that is the case. Gifting involves a trade-off really between control and tax efficiency. That's always been the case, but it's going to be more relevant than ever with the changes we've seen. When you make the gifts, as Lily talked about, thinking about when you do it is really important so they can have as much impact as possible. When working out how much you can afford to gift, you can certainly use My Netwealth as demonstrated by Lily, or you can also consider advice, as I touched on the bottom here, to look at that in more detail. Because as much as the tools are very, very useful, it is often beneficial to speak with somebody to talk through your personal circumstances, and that's more applicable the more complicated your circumstances are. And then the other point really is controlling the controllables, making sure that when you invest, you do it as efficiently as possible. Knowing that you can't predict investment returns, you don't know when you're going to pass away, but you do know that you can keep fees down, you can make sure you're diversified, you can make sure you are invested, and you can make sure that you use tax allowances and exemptions as efficiently as possible. And that will ultimately mean that even with slightly more tax, it means you're still passing on as much as you possibly can. So now I will move on to some questions. I'll leave this on the screen for people to read if they didn't quite take all of that in. I'll start, Lily, with some of the ones that have come in. One question I'll pass over to you, if that's okay, is are the investment costs, which I assume they mean the bottom line item, so the fund costs, is that on top of the investment and advisory costs?
Yeah, exactly. So you have the core costs, the advisory costs for the service, so custody, administration, investment management, access to the advisory team or the full financial planning advice, and then there's obviously some additional costs on top of that for the underlying fund costs. So yeah, it's the core plus the underlying investment fees depending on what risk level, or the advised plus the underlying investment fees depending on the risk level.
Great, thank you very much.
There was a helpful one, Tom, probably for you, that we got sent in beforehand on, I mean, we sort of touched on trusts, but whether we think trusts have a part to play in intergenerational planning, and if so, typically the circumstances that we might see this.
Yeah, so trusts certainly can have a part to play. Interesting tools to be used at certain times. Now, I think it's worth saying in the first instance that trusts are much less valuable now than they were, say, 20 years ago, because there has been a lot of tightening of the rules that mean they're nowhere near as attractive as they once were. But the main benefit of a discretionary trust, that being one of the main two types of trusts that are available nowadays, discretionary trust and absolute or bare trusts. A discretionary trust is, I think, what most people commonly think of when they think of a trust, because it gives the person who sets up the trust full discretion as to what happens. So you might set up a discretionary trust and you might intend for the beneficiaries to be your children, but you ultimately, as the trustee, can change that at any time. So you might decide that you're not going to pass it on to your children anymore. You're going to keep the assets yourself, and then you can make yourself the beneficiary. So because of that, they're not quite as attractive, and it means that if you pay into a discretionary trust more than your nil rate band, more than £325,000, you pay an upfront charge of 20%. So that's not particularly attractive. And you also pay what's known as a periodic charge every 10 years on the excess beyond the nil rate band. So discretionary trusts are quite expensive. They can be complicated to set up. You might need legal fees to look at the different sort of class of beneficiaries. And if you want control, they are good because you get that control, but there is a cost for that. So certainly worth considering. Bear trusts, on the other hand, are much simpler, very useful for children because you can essentially invest in their name in a bear trust. It means once they're 18, they get full access to it. But nonetheless, it's a vehicle for them to invest in before that. So that's also pretty attractive. So yeah, certainly worth looking at, but I think it's worth saying that there's no sort of easy answer there. Either you give up control, you pay into the bear trust, but then the person with that trust can access it when they're 18, or you do keep some control, as you looked at on your slide, looking at the trade-off there,
Mm-hmm.
but you pay more in fees and tax for that privilege.
Yeah. And then I think a question that's come up a lot is
Mm.
about post 2027 with pension funds coming into the scope,
Yeah.
with that double taxation that you touched on. So the inheritance tax plus the income by the inheritor. What are
Mm.
the solutions? Should the tax-free cash be withdrawn now and either invested elsewhere, passed on to the next generation now to
Mm.
avoid that?
Yeah, so I think it's going to depend on individual circumstances, but yeah, for lots of people, it will make sense to take the tax-free cash and gift it. That's a very simple thing to do,
Mm-hmm.
in terms of achieving no inheritance tax ultimately on the gift, but it does mean giving up that control. So you really need to be happy with that. And it's been the case before these changes. Actually, it's just that they're brought more to the forefront now. That the simplest way to pass on wealth is to make gifts. And it doesn't need to be all on day one, but ultimately making the gift, surviving 7 years, will be the simplest way of and the most cost efficient way in terms of legal fees, in terms of reporting requirements. It's much simpler and much easier. It's just you do need to be comfortable doing so. And one thing I didn't touch upon earlier, but certainly worth bearing in mind in this context, is the benefits of financial education for younger people, to make sure that they're aware of the responsibility, aware of the ramifications of taking risk, of not taking risk, of cash flow modeling, looking at how long this asset base might last for you, how much income you can draw. And we certainly find on the advisory side of things that the earlier you introduce children to this, the more they take in over time, and the more seriously they take it, and the less likely they are to do something maybe slightly irresponsible with the money. So bringing children into the discussion, particularly if larger gifts are being considered, is really, really helpful. And of course, it also gives peace of mind that if something was to happen to the person who previously controlled the assets, they might feel more assured that their children just know more what they're doing. It's not going to be such a sudden shock to inherit this money. So that's another beneficial reason to consider some advice or having a
Yeah.
relationship with somebody like us.
I think that's something that we've definitely sort of experienced a bit more since those changes being announced, is looking at opening up accounts for within the network, like I
Mm-hmm.
mentioned, for grandchildren or children, and having one-to-one conversations as an advisor with the person receiving the gift on
Mm-hmm.
risk. What makes sense for you? What are you putting that money towards? And like you said, sort of helping with that education process.
Mm. Yeah, I've got another couple of quick fire ones, which I'll take if that's okay. So
Yeah, sure.
somebody has asked, what are the chances of the changes to the pensions IHT not happening? And I'd say pretty low. It seems pretty likely that this one will come in by 2027. And we did have another question that asked, is there a chance that a future government, say a Conservative government at the next election, could they reverse the rules? And that's a possibility. I must say, I would say quite unlikely, not that I have any inside knowledge, but I think once this rule comes in, it's likely to generate a good sum of tax revenue, and I think it's been considered relatively fair. Although there is a double taxation angle, it was a bit of a an anomaly, shall we say, that pensions were completely untaxed in terms of inheritance tax. People were using them as an estate planning vehicle rather than as a vehicle to solely retire on. So that could change. I could be wrong, but I think it's quite unlikely that it's changed, particularly if it's generating the government lots of tax revenue by this point and the government's finances aren't in a much better condition than they are now. So yeah, possible, but I'd say pretty unlikely. And then there was a question about gifts out of regular income, a couple of questions actually. So one was asking, does it have to be invested in, say, a junior ISA, or can it go to the parent? And gifts out of regular income can go to anyone, actually. So it can go directly to a grandchild. It can go to a parent, so your child rather than the grandchild's. That doesn't matter as long as it's regular income. It can go to anyone. It is often a good idea to pay into a junior ISA though, but for that it's similar to just any other gift. So it can be the parent that pays into the junior ISA, or it can be a grandparent as well. The only sort of slight nuance to that some of you may be aware of is if it's not a junior ISA, if it's just a bare trust that I touched on earlier, then it's much better generally for a grandparent to make that funding rather than a parent. And it's only because if the parent does it, they're taxed as if it's their own investment. But if a grandparent does it, they're not. So grandparents making contributions outside of the JISA is generally better than parents. That's quite a nuanced specific point there. And then the final one I wanted to touch on is a very specific question. I must confess I don't have all of the details, but somebody has asked if they have an accumulating share class in a fund. So it could be a sort of mutual fund, or that's US terminology generally. It could be an OEIC, a unit trust, an investment fund that's pooled for investors. If you have one of those and it's accumulating, so no income's paid out, can you sell assets and gift that as excess income, or can it only be dividends and interest? So normally, as I think I touched on, it has to be income, so it does have to be dividends or interest. Now, accumulating share classes don't have income, as the name suggests, but they do have what's known as it's accumulated income within the fund that's just reinvesting the share. So the manager of the fund does track the income. So it may be possible to gift that element. I must say I'm not certain of that, but you certainly can't sell capital and gift that. It does have to be income. So for funds that do have a notional income, you might be able to gift that. That would be my answer there. But yeah, it'd be worth double checking and getting some specific tax advice on that. Did you have any more, Lily?
No, I think that's all covered from what I can see, but the best chance to run through more specific ones relating to your personal circumstances is obviously to book in those one-to-ones if you haven't already. We can cover off much more specific niche questions there.
Indeed. Excellent. Great. Well, thank you very much for joining us, everyone. We certainly look forward to seeing you at your one-to-one sessions. Yeah, any more questions, feel free to send those in to advice@netwealth.com, or indeed, as Lily says, discuss them with us at your one-to-one session. Thanks very much for joining, and enjoy the rest of your day.